So you've been through one or two of these business cycles,
Yes.
I guess, and with the availability of information and with the number of books being written about this subject, about value and proper investing and how many managers don't beat the market, do you think the average investor is doing anything different than they were 20 years ago?
Well, look, I think there's a minor movement toward indexation. It's not a groundswell. There's still lots of money in actively managed mutual funds where there's 2% a year of fees and costs, or 1.5. But I think there's more in indexation every year, and that's probably appropriate. But I'll just turn it around. I'll leave you with a question. Why can't people beat the market? Because the market's pretty efficient, and market prices most things right, and most people can't find and identify and act on the times when the market prices things wrong. That's why most people can't beat the market. That's what I learned at the University of Chicago, and I think it's pretty true. So the reason for the inability to beat the market is the market's efficiency. The market's efficiency comes from the concerted efforts of thousands of investors who are trying to find the bargains. What happens when they stop trying? So when the interest in active investment declines because people give up on it and turn to passive investing, and all the analysts quit studying the companies, then prices resume their deviation from intrinsic value, then it becomes possible to beat the market again. So it's really paradoxical, and I would say counterintuitive. But I don't think we're close to that day. But in theory, there comes a day when so little attention is being paid to active investing that active investing starts working again. Yes, sir.
Thanks, Howard, for coming for the talk. So you talk about the difference in value and the price. The other dimension is time. So how do you estimate the time taken to that bridge to close?
You never do. You never know. See, what he's saying, I mean, again, it's a very good question. And what we want to do is we want to find things where the intrinsic value is here and the price is here. And so his question is, how do we estimate the time that it's going to take for the gap to close? And the answer is, there's no way to say. On occasion, there are what we call catalysts. And one catalyst would be the pending maturity of a bond. If a bond is going to mature in 2012 and it's selling at 60 because most people think it's going to go bankrupt, but we think it's going to pay off and at maturity, then the date of the existence of a maturity date is going to force the convergence of price to value. Another catalyst today is all these activist investors. They find the company, it's selling, they think the intrinsic value is here, it's selling here because the management is subpar and they're not doing the right strategy. So they go in, they foment trouble, they try to get a board seat, they try to force the management to do the right thing to cause the price to converge with the value. So there are a few catalysts in the world, but generally speaking, you buy a stock, you hope, you think it's worth here, the price is here, you hope it'll converge, but there's no way to estimate the time. And that's the reason why being too far ahead of your time is indistinguishable from being wrong, because it can take a long time.
So would you always look for presence of catalyst when you find a gap?
Well, there aren't enough. I mean, it happens, most of what we do is in the fixed income world, and there are more catalysts in the fixed income world than in the equity world. You find a stock, how many stocks do you think the activist investors go after a year? 10, 20, 50, 100, no more. There are thousands of stocks. So most stocks are never going to get catalyzed.
Curious if you could tell us what it was like when you were out raising money for Oaktree in the early days. I would imagine that today some clients are skeptical, but I would imagine that was it a lot different for you back then? And
well, by the time we started Oaktree, it wasn't that hard because we had a reputation. But when when I started raising money for our strategies, 1978 junk bonds, 90% of investment organizations like Google had a concrete rule against any bond investing below A or below investment grade, which is triple B. And of course, Moody said it's an imprudent investment. So that was very, very hard to overcome. But what you have to do is you have to find a few people. You see, you have to find a few people. You have to go say to them, you should do this because nobody else is. Because nobody else is doing it, it's languishing cheap. You make no money doing the things that everybody wants to do. You make money by doing the things that nobody wants to do, who then turn out to have value. And if you say that message to 100 investors in the beginning, maybe 10 jump on board. After it works for a while, then the rest come on, like the screen says. But hopefully not too extreme. But the point is, it was very hard in the beginning. And you know, in certain foreign countries, it was even harder, because in certain foreign countries where the thinking is a little more narrow than American thinking, I always thought that if I go into somebody's office, I say, you should do this because nobody else is, they'd call the man in a white coat to take me away. They don't understand. You know, I think that Americans semi-intuitively understand the value of contrarianism and of being a maverick. But in many countries, they just don't get it. So that's an example, high yield. Now, but then we started Oaktree in, no, that was a Citi. In '85, I switched from Citi to Trust Company of the West, TCW. And in '88, we brought out the first distressed debt fund. Now, we're not investing in companies that have a risk of default. We're investing in bonds that are either in default or sure to be. And people would say, well, how can you possibly make money investing in the bonds of bankrupt companies? And we had to explain to them that if a creditor of a company doesn't get paid the interest and principal as promised, they have a claim against the value of the company. And they exert that claim in a process called bankruptcy. And in bankruptcy, to oversimplify and overgeneralize, the old owners are wiped out and the old creditors become the new owners. And if you bought an ownership stake through the debt for what? For less than it's worth, then you make money. And you know, we've made about 23% a year for 28 years investing in distressed debt before fees without any leverage. So that's pretty astronomical. Why? Because from time to time in distressed debt, you get to buy things for less than they're worth. And in fact, because other people are fleeing from the bankruptcy, maybe you get them to buy them for a lot less than they're worth. So, you know, it was very challenging, but you know, if you can, and you can't convince everybody, but if you can explain the merits and tell the story clearly and concisely and persuasively, then you get some clients. And then if you get good results, then you get more clients.